start that one again. Today is Wednesday, December 2nd, lost track of time, and 11 a.m. section. Recording is on. We are going to talk about homework 12, and hopefully this shouldn't take the entire class. And so if we can get through this, then I'll give you the balance of time to work on your group project, which is due on Monday. So again, just as a reminder, on Monday by 10 a.m., make sure you turn in your PowerPoint for your analysis on your group project. Basically, that's what you're going to be presenting on. You're not going to be using Excel. So put all of the Excel data that you need into that PowerPoint. Again, list your team, name of people on the team. And again, I would say you have at least 6 slides. You might do more, but you should have a slide on the PE. You should have a slide on that EV multiples, EV to sales, EV to EBIT. And essentially you're repeating that 3 times for each part of CVS Health. So CVS against each of their 3 segments. That would be a minimum as you're going through. You'll have 10 minutes. Again, question at the end. And we'll get through all 6 teams on Monday. So that is our plan coming up. Any questions about that? Somebody just sent me a message in the chat asking if I was taking an attendance screenshot. Attendance is not by screenshot. Attendance is by registration on Zoom. So you have to be registered in Zoom in order to be attended for the class. So back to this. Questions about Monday. Any other questions about Monday? All right, if there's no questions about Monday, let's talk about Procter & Gamble and its peers. So I'm going to go ahead and share my desktop here so I can jump around. So let's start out with the doing the PEs. So this was most of the raw data that I got as I was doing this. But before we talk about this, I noticed for expected ROEs that there were 3 issues that came up. One people emailed me about. The first one was about Procter & Gamble's return on equity. And basically somebody sent an email, said they only saw 3 years worth of data. Year 4 was blank. Okay. And the point of the averaging of 4 years, which is what we did originally, was not saying that you always have to take a 4-year average into perpetuity. What we were saying is we were looking for a way to get a representative number. And so I thought that in averaging the 4 years, since they were relatively consistent, would get us a representative number that I thought would be representative for the longer term. So if they don't have a 4th year, doesn't mean you can't do the exercise, just means you got to figure out with the data that you have what is representative. Now for Procter & Gamble, if we did look at their, I'll go back to the screenshots here. Here's the screenshot. So if I look at their return on equity, it's in the low 30s for the next few years. And so I actually think that using something as I used a 3-year average to get 34%, but the idea is that using something in the low 30s probably makes sense for them long term. And that's a simple way to think about it for Procter & Gamble. Because remember, the whole point here is we're putting into the key value drivers, which are 4 numbers, which represent the entire value of the firm. And so essentially, we got to have representative numbers. So what is a representative growth rate? What is a representative WACC? What is a representative ROI, ROIC, ROE? That's what we're trying to get to. So for Procter & Gamble, I think somewhere around 34 seems reasonable to me. Now, if you said 33, okay, but somewhere in that range, right? Clorox, a little bit more of a challenge, because if you look at Clorox and you look at their expected return on equities for the next few years, I'll make this a little bit bigger. It starts very high. Last year was about 130% and goes down to 54. And so we don't even have to look this up, but we could. And if we went back to their income statement, what we would see is similar to what we talked about Lockheed Martin. They don't have a lot of equity, and they're not really growing fast, and they're paying out a very high payout rate. So essentially, that is what's happening between share repurchase and dividends. Matter of fact, you can even see it right here. We don't really talk about this semester, but DPS stands for dividends per share. So this is expected dividends. There's earnings per share. So if you just looked at it purely dividends, I mean, it's over 50% that they're paying out just in dividends. That's before they get the stock repurchases. So the point is, one of the reasons why they have a high return on equity is they've been paying out a lot. What's reasonable over time? This return on equity is probably more representative of the long term, because like I said, going over 100% is pretty hard consistently for firms. Just nobody has that over the long term. And at some point, they're not going to be able to pay out at the rate that they're paying out and have, the business is going to start to fall apart. So, 50% sounds to me more reasonable than 100% when we came in. But we're now also getting to the point for all of these companies that they have pretty extreme return on equities, which means there's not a lot of huge investments beyond depreciation in these businesses. So ultimately, I think if you used a high double-digit number, anywhere in that should be less than 100%. And that's probably what we're looking at here for Clorox. And so what I ended up doing is I put in just 54%, which is I used the last year's number. You didn't have to use the last year's number. You could have, used it an average of a few, you see some 70. But as we talked about in the last class, whether you use 50 or 70%, it's not going to make too much of a difference once you get that high in terms of impact on the actual PE. And then the other one was Clorox, or sorry, Colgate. It was Clorox. So for Colgate, if we're trying to figure out what their return on equity was, again, similar to all these other companies, they don't really have any equity. And again, DPS, dividends per share, earnings per share, very high payout rate. Again, buying back stock, no equity in this firm, paying out a lot in dividends. And that's what you're seeing here in terms of the business. So ultimately, from a return on equity standpoint, you just need to have a high number, because they're probably in a similar situation to Clorox, where they're pretty much paying out most of their equity. Again, I generally don't like to have ROEs above 100%, but you could, whether it's again 100%, 80%. I used 80. Anything in that range. It's very similar to Clorox, and these two numbers aren't going to make too much of a difference even in our analysis. Do you guys use things different? Any other changes? Thoughts? Did you guys address this? Do those seem reasonable? What'd you do? We okay with these numbers? My speaker's broken.
For the WACC, I based on the Dutch Bank estimate, and I use around 6% for Clorox, because I think they are in the same industry and like have same risk. So I use that number instead of the 4.3.
Okay, so let's address the WACC here of Clorox. Okay, 2 point values in here. So if we use the 4% WACC, and let me do this really quick, 2%, 3%, and this is going to be like, I don't know, 1 or 0. What is this?
Oh, no, I mean, I use it for the EV, EBIT, not this one.
So you didn't change the cost of equity.
No, yeah, no, sorry.
If you're going to change the WACC, you would have to change the cost of equity, just realistically, because you can't have a cost of equity lower than your WACC. Because basically, equity is always more expensive than debt, right? Just because they take more risk. They're the last to get paid. And if your WACC is higher than your cost of equity, that would mean that your cost of debt is higher than your cost of equity, which means the bondholders want to have a higher return than the shareholders. Who would want to be a shareholder at that point? You'd want to be a bondholder. So if you raise the WACC, you have to also raise the cost of equity. That just to be consistent in your approach. So you can't do one without the other.
Okay.
So you would have to put it into both analysis. So I'm not disputing that. I'm actually going to try and make the point that you're making here. So if I solve for this, take this extra decimal place thing. 0.0 was it? 38 probably, close enough. All right, if I go with this cost of equity, we'll just use this for the PE. That's my growth rate. And I'm going to do a Clorox 2 over here, or alternative, versus, I think you said 6. So if you went, what did you say, Barclays used 6% for their WACC, 6.5?
Yeah, 6.
6?
Yes, 6.
Okay. If they're using 6, okay, which basically says closer to what these other two companies are, Procter & Gamble and Clorox, then let's assume some more cap structures, and they're both at 6.6. This should probably also be 6.6. Okay, assuming that they have the similar capital structure and similar amount of debt in their firm. So that would have been your assumption. You should have said, okay, I'm going to adjust the WACC. So this is 6.6. And then if I make this 6.6, then, or 6, and then basically they're both at 6. These companies are at 6.6. So somewhere around 6.6 is probably seems right for what I should be using for a cost of equity, assuming a similar cap structure. And again, we can go back and see if Clorox has more debt or equity, adjust it a little bit, but I think we'd probably be in a reasonable range given the assumptions that we're making. So then the point is, okay, well, what does the growth rate have to be in order to do this? Well, here's the point. Somewhere around this growth rate, 2 point, what's that? 2.8 maybe? No, 2.9. There we go. So the question is, which of these two Colgate scenarios or Clorox scenarios makes more sense for the G? Are they growing similar to their peers? Or are they growing slower than their peers? That's really what we're trying to assess if you use the scenario. Because if you're raising the risk, then you're obviously raising the cash flows. So that's the point. So I'm going to be discounting at a higher rate. I therefore need more cash flow to discount the higher rate to get to the same value. So I either have more cash flows discounted at a higher rate, or I have less cash flows discounted at a lower rate. So back to the story. What's going on with Clorox compared to the industry? This, by the way, is another reason why we like to do EICs, right? Because without the context of the industry analysis about how fast this industry is growing, without the context of Clorox's lack of competitive advantage or wherever they stand, it gets harder to assess whether or not I think you're going to grow slower or faster than the industry, because we just lack information here. And so that's one of the things that is kind of affecting us when we're trying to make this choice. It's not just purely a mathematical choice, meaning we should have some rationale behind our math, okay? But if nothing else, what I do appreciate is you've kind of sniffed out, okay, this is something that we might want to look at because, if nothing else, why is there risk so much different than their peers? And is that legit? Like, are they really less risky than their peers? Or is there some kind of aberration that's happening to their number right now? And long term, I need to adjust it. So if you took the analyst report that you looked at, that's what they were doing. They were doing similar logic, is they're saying, all right, I need to adjust it so it's more column E. And that was the scenario that they're probably using. If you didn't adjust it, you'd use column C, which is the straight Bloomberg data. So back to, let's get at least a clue. I don't know if this is a final answer, but let's at least look at a clue. So if I go back to, and right now the real question is Clorox. I want to see two things. One, what are the analysts actually expecting? And in this case, I'm going to look at the growth rates. So I'm going to switch this from dollars to percentages. And I'm going to look at it in terms of, now technically it's growth in net income that we're looking at, G, but we're using revenue growth as a proxy. And the idea is that if a company has a consistent margin over time, growth in sales and growth in profit should go up the same rate. Okay. And if a company has the same capital structure over time, then growth in sales and growth in profit, ROIC, should be the same over time. ROIC shouldn't be changing either. So more productivity essentially is what we're assuming. So obviously those can change, but let's just assume that they don't. So again, we use growth in sales as a proxy. If we do think they're going to change, we have to come up with some other method. But the point is, look at these numbers, 7, 1, 3, 4. What the analysts are probably saying is 0.38% growth looks a little low because they're not forecasting that. They're forecasting a consumer products industry, also a CPG, is growing, globally 2-3%, US GDP at least, and then Europe's growing in that range, Asia a little faster, and so Clorox, basically, if I assume that they're kind of growing with their markets, 3% sounds more reasonable than 1%. So you could make an argument that the Clorox alternative to the bleach, terrible pun, sorry, gotta have my fun being stuck here in quarantine, but in any event, probably makes more sense on what we want to use. So column E makes more sense. Now, I'm not saying you can't explain column C. You absolutely can explain column C when you do your analysis, but column E is probably a better approach. Questions? All right. So these multiples are pretty close together. And so that would actually be the point. Like what's really the difference between these companies? Not a lot. And if you really look at it, and if we went with the column C approach, and you're trying to explain the differences, well, obviously risk, because of the assumption we just made, there's no difference in risk in these three companies. So really, why is Colgate, for example, CL, trading at a premium to P&G? It's because they have slightly higher growth, 3% versus 2.7, because they're expected to have a slightly higher return on equity, anywhere from 60% plus, depending on where you did. But it's just they are a little bit more growth at a little bit more return on equity, depending on what number you use. But that's what you would say about Colgate in terms of why they would be trading at a premium of 26 versus 26.7 versus 23.6. If you looked at Clorox using these assumptions, why are they trading at a premium to Procter & Gamble? Again, risk is out. They have an expected return on equity that is also probably higher than Procter & Gamble. They have a little bit higher or similar growth, but a little bit higher, 2.86 versus 2.7. And so it's slightly higher, extra 16 basis points or so of growth and incrementally a little bit more return on equity. For more risk, they're trading at a premium. So what the market is basically saying, if we kind of take this Clorox alternative approach, that they have a similar risk, is that Procter and Gamble, if you really look at it, they are underperforming on the multiple mainly because it's not by much. I mean, 24 versus 27 times earnings, not a huge spread between the two, but basically it's because they incrementally have a little bit less growth, but it's really because they have slightly lower returns, and that Colgate and Clorox right now are being more valued because of their extra payout, which is, you know, basically giving them a little bit of a premium in this marketplace. Questions, comments, alternative opinions? Then you'd have done EV to EBIT. And so for this one, you know, tax rates, looks like Procter & Gamble does have a little bit lower tax rate according to the analysts going forward. I got this, I used 3 JP Morgan reports for the 3 companies. If I looked at the expected ROICs, these were the ROICs from our formula for operating ROIC for last year. And I'm assuming that they're not going to change too much. And the basis for my assumption is that the ROE isn't changing, right? These companies are all having high ROEs. And so therefore, they're probably going to consistently have high ROICs. And the other thing that what's behind using these numbers is that in my return analysis for PE, both it looks like Colgate and Clorox had higher returns than Procter and Gamble. That's what their multiple suggested. So the idea that the operating ROIC being higher at Clorox and Colgate makes sense. And so therefore I'll keep that assumption played out here and use these numbers. I'm more comfortable with these numbers as well, right? So then the real question is back to the WACC. And what are the growth rates that are we going to get on this? Do I need to change my WACC? Well, if I use these growth rates, then this is going to be like 2.4, 2.3. All right, this one, if I use the lower WACC, this growth rate is going to be what, 1%. No. Looks like close to 0. And this one is going to be 3, no, 2. Somewhere around that. So then, similar idea. If I make this the Clorox alternative, and I made this 6, then notice I can't have 0% G, and then this becomes somewhere around 3. No, it can't be 3. Somewhere in that range. So it goes back to, do I believe in Clorox or do I want the Clorox alternative to explain my story? Well, if I go back to the same logic I used for the PE, the Clorox alternative of the 6% WACC might be a reasonable argument, because 0 growth into perpetuity for Clorox versus 2.25%, I'd lean more towards the 2.25%, trying to explain it, what the company is having, for the same reason that we chose to have some growth in the PE multiple versus no growth at all. So it's just a question of, again, which scenario plays out better in a long-term view. Does it say that, look, this company has no growth prospects and their value is all about the fact that they're not very risky company? And I just think that that's less likely than they are growing, and there's just sort of an aberration in the data we're looking at Bloomberg right now. So therefore, I'm more thinking about a long term, that their risk is probably similar to their peers, and that therefore at that level their growth is going to be similar to their peers. And to me, that seems like a reasonable assumption to make, pending a more thorough EIC analysis, obviously, if we're really doing this. But that's what we would be looking at. Again, questions about the logic, about the changes, why I'm doing it, why it didn't do certain things.
Yeah, I have a quick question.
Yeah.
So I went with the alternative with very little growth, and I basically justified it by doing a quick search of like recent innovations between the three companies and seeing that like Procter and Gamble and Colgate have like recent awards or new products or things like that, whereas Clorox has mostly just been doing like very minor incremental updates on existing products. So I'm
Yep.
just curious what you think of that justification, or if you would have done it differently.
Well, first, I commend you for taking the extra step to do that research, because that's ideally what we want to do. Because the problem with this is we don't have enough information to make these decisions. And if nothing else, that should have been one of the key lessons that you learned out of this class that he's highlighting here to remember when you get to your careers. So many people think that the numbers are the answer, and they're not. The numbers are based on assumptions, they're based on decisions. And so the numbers are just the starting point to ask the questions to go figure out more information. In this case, what assumptions to use. And so that's what you're trying to do here, and eventually trying to make a story that makes sense. So there's an argument to be made. And as I said, I'm not saying that the one I'm giving with the Clorox alternative is the only one to be made. You could make the one that you just did, which is, hey, Clorox lacks competitive advantage. They're not really innovative. And the market is concerned about that. And so based on the lack of innovation, they don't think that they're going to have as much growth in the long term. And it is a lower growth. And so with lower growth, then it does suggest that it's a WACC that is lower. And you could argue, why is the WACC lower? Well, they're basically, they're commodities, but at the same time, like, they're bleach, and bleach isn't going anywhere. So, they're probably a fairly stable business, because in good times, bad times, people are going to buy bleach and some of their other cleaning products. So I don't view them as too risky. So you can kind of follow through some of your logic and justify column C. I'm not saying it's wrong. You can make either story. Now, I'm just telling you that if I put probabilities in each, I think column E is more likely than column C, and the answer is probably somewhere in the middle. But the idea is that you could absolutely say column C and be correct, even in the real world beyond this class. Other thoughts, questions, comments about this? But this does highlight one thing that I will expect on Monday, by the way, which is, we've been working on CVS now, going on 2 months. You've done an EIC. You've done a historical analysis. You've done evaluation with scenarios. So and as a bonus, you got to hear from the CVS Aetna CFO. So I fully expect that when we come to Monday, there shouldn't be, well, I don't know why this number is what it is against everybody else. Like, that shouldn't be the case. You should start to have opinions based on data that is out there, well formed, about why these numbers are different when you're looking at them. So if you're doing, CVS against Anthem, or, pick whatever company you're doing, United Health Group, it shouldn't just be, well, they're just a little higher. Because if my question is why, what about this, then you should be explaining why they're trading at a premium or discount, and know why, not just because the number says so. There should be some context to that. That's what will make a better presentation on Monday. So somebody says separately, direct message, I think it's probably worthy to mention for the class. They said, well, Rite Aid has a negative ROE because they're going through a new acquisition. Would we have to change that? So my question to you is Rite Aid's negative ROE representative of perpetuity? Just think about that, is because that's what you're doing here. When you put in these numbers, this means forever. So are they going to have a negative ROE forever? Well, if they're going to have a negative ROE forever, they don't exist. Like they can't exist with a negative ROE forever. They would go bankrupt. Nobody would invest in that company. And so of course they can't have a negative ROE forever. So if they have any positive value, they would have to have eventually a positive ROE. So the problem is they don't right now, but they have to. Otherwise, how could they have a positive value as a firm? So what you have to do is you have to basically price them as if, what will that return on equity be post reorganization or whatever they're going through? And what might the numbers that the market is thinking that they're going to earn long term? I mean, one of the insights you can get is, remember we were doing Delta Airlines, that I said, look, we might have to look back to the past at a time of profitability to figure out what an airline might actually make in the future, because the next couple of years, they're not going to make anything. So I can't use the next couple of year numbers to represent the long term. Remember that conversation with Delta? So the same thing might actually apply as you're going through this analysis for another company. In your case, the question you're probably asking me about Rite Aid. All right, and then if we're trying to explain this, why is, and so it just depends on which one you're doing. Why is Procter & Gamble trading at, in this case, a slight discount on EV to EBIT to Clorox and to Colgate? Well, I mean, essentially, if the WACs are pretty similar, it's not the WACs, right? And obviously the tax rate at Procter & Gamble is lower than the other two, so that should be helping their multiple. All right, so the 18.6 going against 21, 20.7 and 23.8, that's not helping Procter & Gamble. So they're not trading at a premium or a discount because of tax rate. Lower tax rate should be helping them. And so if you look at it, it's basically, if I look at Procter & Gamble against Colgate, basically 2.34, 2.42 are the same growth rates. It's a little incrementally higher. It's like 8 basis points using their formula, but it's a virtual tie between the G's. So why? Because Colgate's expected to have a higher ROIC. That it almost confirms what we're seeing here in the data, because you have the same growth, you have the same risk, the tax rate's lower, which should actually help you, and you're still trading at a discount. Then the only other thing that makes sense is that you're not expected to have as high a return, which, by the way, is consistent with what we heard when I was trying to explain what's going on with the PE, of why they're trading at a slight discount in the PE as well. So that makes sense for why Procter & Gamble's trading at a slight discount. And I say slight because we're talking about 19.6 versus 19.8 for Colgate. And again, why are they trading at a slight discount against Clorox? Well, again, it depends on my scenario, but slightly, again, similar WACC. If I go with a similar WACC approach, then again, it's basically Clorox has about the same G, slightly higher tax rate. So again, it's their implied ROIC is higher. So both Colgate and Clorox, if we go with a similar risk approach, are trading at a slight premium because they have incrementally higher expected ROICs, 35% in the case of Clorox, if I go with the 6% WACC scenario. If I don't go with the 6% WACC scenario and I go with the 0% growth scenario and the 4% WACC, well, why is Clorox trading at a premium? Well, then it's all about the WACC. Then you're basically arguing that Clorox has no growth. And so basically Clorox is all premium, is all about less risk. So if I think about it as an investor, do I think that long-term that Clorox is less risky than Procter & Gamble? And I don't know. I don't know the answer to that question. That's what I'm leaning towards the Clorox column E alternative as my explanation. But if I went down that scenario, then that would be the point. The 4% WACC explains the slight PE, because if they had a 6% WACC and no growth, you can do your little what ifs here. They'd be trading at 13 times earnings. So they're not trading at 13 times earnings. So what's trading them higher is the WACC. Okay? So then the other question becomes, well, EV to sales, right? Why is Procter & Gamble trading at a premium, I'll go Clorox first, of EV to sales over Clorox? Well, number one, Procter & Gamble has highest margins in the industry at 24.4% pre-tax and 19.9 after tax, because they also have a lower tax rate. But if I look at Clorox has lower margins, 19% pre-tax, 15% after tax, but they're spending half the reinvestment. Okay, and that's what I mentioned. Like, this is a company, if I go look at their data, that is not really reinvesting in their business. They're paying out. It's a high payout rate company, which also suggests lower growth, by the way. But because again, if you're paying out, you're not growing. But back to this, that is probably why you're actually seeing a lower EV to sales. Okay, because it's a combination of lower margin, and again, the lower productivity should be helping them, right? But it's just low margin. Okay, so it's low margin, and the higher WACC should be helping them. Or sorry, the higher ROIC should be helping them. So if they're trading at a discount with a higher ROIC, lower productivity, it's not making it up enough. So I don't think a low discount rate is helping them. So I'm more inclined by looking at this EV to sales to believe this WACC, because the higher discount rate probably leads to more of a discount on enterprise value to sales, given the difference in margins. But the point is that it's the difference in margins. It's very clear as to why Clorox is trading at a discount, 3.8 versus 4.8. It's primarily because of their margins, but I think it's at a similar WACC. So I'm actually believing column E. Why is Colgate trading at a slight premium, or basically a virtual tie? Well, Colgate and Procter & Gamble have virtually identical margins, right? Colgate is more efficient, but Procter & Gamble pays less taxes. That affects profitability and profit sales, which is essentially they're benefited by the higher return because of this productivity, but I think it's being offset by the tax rate here. So what actually helps Procter & Gamble offset this productivity gap, 0.81 versus 0.54, is the fact they're paying 4% less per dollar in taxes. And so that's why they trade at a slight discount to Colgate, even though they're spending more gross investment, more on their actual reinvestment in the business. Again, a lot, as I said, questions, comments, thoughts. All right. So that is it for today. Somebody asked me in the chat about the final extra credit. It will be next Wednesday, 1 week from today. Okay. And it'll be a simple assignment, probably an in-class assignment that you can get done just to try and knock it out of the way as quickly as possible, because pretty much content-wise, we're done. And so, because after you do your presentations on Monday, there's obviously no more content for the rest of the semester. So basically, the final extra credit opportunity will be next Wednesday. okay, after the grades are in from your presentations. All right. So if there are no other questions, like I said, I'm going to give you the balance of time today to work on your group projects as teams. So again, remember to submit your PowerPoint file Monday by 10 a.m. as a team. And then essentially you'll have 10 minutes. And remember, you're presenting out of the PowerPoint. Put everything in the PowerPoint, including what's in your Excel. Right. Otherwise, remember, TAs have office hours tomorrow and Friday. Stay safe out there. It's getting dangerous. And otherwise, have a good weekend. I'll see everybody on Monday.